Let's cut through the noise. You're not here for philosophy, you're not here for a history lesson. You are here for yield. You are here for alpha. You're tired of complex liquidity pairs, you're tired of impermanent loss, and you're looking for a more capital-efficient way to make your stablecoins work for you. That's where Platypus Finance comes in. Its core innovation, single-sided liquidity, is a game changer. But simply depositing your assets into a pool is the beginner move. That's playing the game on easy mode. Today, I'm giving you the full playbook for hard mode, the strategy to not just use Platypus, but to maximize it. No fluff, just the data, the mechanics, and the strategy to extract the highest possible yield from this protocol. Let's get started. Playbook Chapter 1. Understand the machine. Before you deploy capital, you must understand the machine you're operating. The beauty of Platypus is its simplicity on the surface with depth underneath. The core function you need to understand is this. Platypus separates the act of providing liquidity from the risk of price volatility. By allowing single-sided deposits, you can provide, for example, 1 million USDC without needing to hold $1 million worth of another asset like AVAX or PTP. This is revolutionary for a yield farmer. It means your underlying capital is not exposed to the impermanent loss that plagues traditional AMMs. Your risk is isolated, primarily to smart contract risk and the stability of the stablecoin itself. This is a massive improvement in risk management. Now let's talk about the engine of this machine, the tokenomics. There are only two things you need to obsess over: PTP and vePTP. PTP is the reward token. It is the yield you are farming. vePTP is your yield multiplier. It is the tool you use to dramatically boost your PTP rewards. Our entire strategy today revolves around optimizing the relationship between these two variables. Your goal is not just to earn PTP. Your goal is to accumulate vePTP to turn your yield farming from a garden hose into a fire hose. Playbook Chapter 2. Initial Deployment, the First Deposit. This is the practical, step-by-step part. We will walk through the first deposit, but with a strategic mindset, not just a blind one. Step 1. Choose your asset. Navigate to the Pool section of the Platypus app. You will see the main pool with various assets like USDC, USDT, DAI, and others. Do not just deposit into any of them. Hover over each asset. You will see a base APY. This is the yield you get without any boosts, but more importantly, look at the PTP rewards allocation. Some pools are incentivized more heavily than others. Your first strategic decision is to choose the stablecoin that offers the best combination of a solid base APY and high PTP emissions. This can change based on governance votes, so always check the current numbers. Step 2. The deposit. This is straightforward. Connect your wallet. I assume you know how to do this. Go to the Deposit tab. Select your chosen asset. Input the amount. You will need to approve the token first, which is a standard blockchain transaction. Then you click Deposit. Your funds are now in the Platypus pool, but you are not earning PTP yet. This is a critical mistake many beginners make. Step 3. Stake your LP token. When you deposit an asset, Platypus gives you a receipt in the form of an LP token. This token represents your share of the pool. To start earning PTP rewards, you must take this LP token and stake it. Navigate to the Stake tab within the same pool. You will see your available LP tokens. Click Max, then Stake. Now, and only now, are you officially farming PTP. You can monitor your unclaimed PTP rewards accumulating in real time on this page. You have completed the basic steps. You are now earning yield. But this is where the amateurs stop. We are here to maximize. This brings us to the most important chapter. Playbook Chapter 3. The vePTP Gambit. Activating the multiplier. The base yield is for everyone. The boosted yield is for the strategists. The vePTP system is your key to unlocking the highest returns on the platform. First, you need PTP. You can either claim the PTP you've been farming, or you can buy it directly from an exchange like Trader Joe. Once you have PTP in your wallet, navigate to the stake section on the Platypus website. This is different from staking your LP tokens. This is where you stake your PTP itself. Here, you will see the core mechanism. You lock your PTP for a specific period of time. The longer you lock it, the more vePTP you receive in return. This is a trade-off between yield power and capital flexibility. Let's analyze the strategy here. A longer lockup, say for the maximum period, gives you the highest possible vePTP amount per PTP. This gives you the maximum boost on your yield farm. It signals to the protocol that you are a long-term believer in Platypus. This is the path for maximum reward. However, it also means your PTP tokens are illiquid. You cannot sell them. You cannot react to market conditions. You're making a high-conviction bet on the long-term success of Platypus. The no BS approach here is data-driven. You must look at the boost calculator on the staking page. It will show you exactly how much your APY will increase based on the amount of liquidity you have provided and the amount of vePTP you hold. Let's say the base APY is 8%. By accumulating a significant amount of vePTP, you might be able to boost that APY to 20%, 30%, or even higher. Your task is to calculate the break-even point. You need to ask, how much additional PTP will I earn from this boost, and is that extra yield worth having my initial PTP tokens locked for this period? This is a dynamic calculation. It depends on the PTP price, the amount of liquidity you're providing, and your personal risk tolerance. The key takeaway is this: do not ignore the vePTP system. Ignoring it is like willingly accepting a lower salary. Your first 3 plays are set. Understand the machine, deploy your capital, and activate your multiplier. This foundation separates you from 90% of the users on the platform. You've now executed the first 3 plays from our book. You understand the machine, you've deployed your capital, and you've activated your yield multiplier with vePTP. This foundation already puts you ahead of 90% of the users on the platform. But we are not here to be in the top 10%. We are here to be in the top 1%. To do that, we need to master the next most crucial chapter in the playbook. Playbook Chapter 4, the compounding engine, to claim or to compound. You will now see your PTP rewards accumulating in real time. Every few seconds, another fraction of a token appears. The temptation is to let it sit there or to claim it and sell it for a quick profit. But a strategist does not act on temptation. A strategist executes a plan. When it comes to your PTP rewards, you have 3 primary strategies. You must choose one and execute it with discipline. Strategy 1, the claim and sell, the mercenary play. This is the most straightforward, low-conviction strategy. On a regular basis, maybe once a day or once a week, you claim your farmed PTP rewards, you bridge them to a DEX like Trader Joe, and you immediately sell them for a stablecoin like USDC or AVAX. The pros: you are constantly realizing profit. You are converting a volatile reward token into a more stable asset. This is the safest way to lock in your gains and reduce your exposure to the PTP token's price swings. The cons: you get 0 compounding effect on your rewards. Your vePTP balance remains static, meaning your boosted APY will not increase over time. This strategy maximizes immediate cash flow, but sacrifices long-term potential. Strategy 2, the compound everything, the believer play. This is the highest conviction strategy. Every time you claim your PTP rewards, you immediately go to the staking section and lock them up for more vePTP. The pros: you are creating a powerful compounding flywheel. As your vePTP balance grows, your boosted APY increases. As your boost increases, you earn PTP even faster. As you earn PTP faster, you can stake it for even more vePTP.
This is how you achieve the highest possible APY on the platform. This is the path of maximum long-term reward. The cons: you realize zero immediate profit. All your rewards are being funneled back into the system. You are dramatically increasing your exposure to the PTP token and locking up more and more of your capital, betting everything on the long-term success and price appreciation of Platypus. Strategy 3. The hybrid approach, the strategists' play. This is the most balanced and, for many, the most rational approach. You set a rule and you stick to it. For example, the 50-50 rule. Every time you claim your PTP rewards, you sell 50% for stablecoins, taking profit and de-risking. You then take the other 50% and stake it for more vePTP, compounding your advantage. This allows you to enjoy the best of both worlds. You are consistently taking profit off the table while also consistently increasing your long-term yield potential. You can adjust the ratio based on your conviction. If you are very bullish, maybe you do a 25-75 split. If you are bearish, maybe 75-25. The key is to have a system. Do not make this decision based on emotion or the daily price chart. Choose your compounding strategy and execute it like a machine. Playbook Chapter 5: Risk Management. How not to get wrecked. A true alpha hunter is not just aggressive. They are a master of risk management. A single catastrophic loss can wipe out a year of careful gains. Given Platypus's history, ignoring risk is not an option. Risk 1. Smart contract risk. Let's be blunt. Platypus has been exploited before. The code is complex. While audits and fixes have been made, there is a non-zero chance it could happen again. This is a risk in all of DeFi, but it is particularly pronounced here. Mitigation. The #1 rule of DeFi: never put more money into a single protocol than you are willing to lose entirely. Diversify your farms. Spread your capital across multiple uncorrelated protocols. Do not treat Platypus as your savings account. Risk 2. Stablecoin depeg risk. You're earning yield on assets that are supposed to be pegged 1-to-1 with the dollar. But as we've seen with UST and others, not all stablecoins are created equal. Mitigation. Understand what you hold. Is it a fiat-backed stablecoin like USDC? An over-collateralized one like DAI? An algorithmic one? Diversify your stablecoin holdings within the Platypus pool itself. Do not go all in on a single stablecoin, no matter how high its individual APY is. Risk 3. PTP token price risk. Your boosted rewards are paid in PTP. A 500% APY doesn't mean much if the token you're being paid in goes down 90%. Mitigation. This goes back to your compounding strategy. The only way to mitigate this risk is to consistently take profits. Selling your PTP rewards for a stablecoin is not just profit-taking. It is active risk management against the volatility of the reward token. Conclusion: the mark of a true strategist. So, there it is, the complete playbook. It's a system of understanding the machine, deploying capital, activating your multiplier, choosing a compounding strategy, and obsessively managing your risk. The real alpha, the real secret, isn't some hidden setting in the app. The real alpha is discipline. It's having a rational, data-driven process in an ecosystem that is often driven by pure emotion, hype, and fear. So, review this playbook, choose your strategy, define your rules for compounding and risk management, and then execute that plan with precision, day in and day out. That is how you move from being a simple yield farmer to a true DeFi strategist.